Risks and methods of money laundering and terrorist financing. Overview. What is money laundering? Money laundering involves taking criminal proceeds and disguising their illegal sources in order to use the fund to perform legal or illegal activities. Simply put, money laundering is the process of making dirty money look clean. When a criminal activity generates substantial profit, the individual or group involved must find a way to use the fund without drawing attention to the underlying activity or persons involved in generating such profit. Criminals achieve this goal by disguising the source of funds, changing the form of the currency, or moving the money to a place where it is less likely to attract attention. Criminal activities that lead to money laundering, such predicate crime, can include illegal arms sales, narcotics trafficking, contraband, smuggling, and other activities related to organized crime, embezzlement, insider trading, bribery, and computer fraud schemes. Formed in 1998, the Financial Action Task Force (FATF) is an intergovernmental body created by the Group of 7 industrialized nations to set standards and foster international action against money laundering. One of FATF's early accomplishments was to dispel the notion that money laundering only involves cash transactions. Through several money laundering typologies exercises, FATF demonstrated that money laundering can be achieved through virtually every medium, financial organization, and business. The United Nations 2000 Convention Against Transnational Organized Crime, also known as the Palermo Convention, defines money laundering as the conversion or transfer of property, knowing it is derived from a criminal offense, for the purpose of concealing or disguising its illicit origin, or of assisting any person who is involved in the commission of the crime to evade the legal consequences of his or her action. The concealment or disguise of the true nature, source, location, disposition, movement, or rights with respect to or ownership of property, knowing that it is derived from a criminal offense. The acquisition, possession, or use of property, knowing at the time of its receipt that it was derived from a criminal offense or from participation in a crime. An important prerequisite in the definition of money laundering is knowledge. In all three of the definition above is the first, knowing that it is derived from criminal offense. And a broad interpretation of knowing is generally applied. In fact, FATF's 40 recommendation on money laundering and terrorist financing and the 6th European Union Directive on the prevention of the use of the financial system for the purpose of money laundering and terrorist financing stated that the intent and knowledge required to prove the offense of money laundering includes the concept that such a mental state may be inferred from objective factual circumstances. Several jurisdictions also use the legal principle of willful blindness in money laundering cases to prove knowledge. Courts define willful blindness as the deliberate avoidance of knowledge of the fact, or purposely indifference, and have held that willful blindness is the equivalent of actual knowledge of the illegal source of funds or of the intentions of a customer in a money laundering transaction. After the event on September 11, 2001, in October 2001, FATF expanded its mandate to address countering the financing of terrorism (CFT). Both terrorists and money launderers can use the same method to move their money in way to avoid detection, such as structuring payment to avoid reporting and use of underground banking or value transfer system, for example, Hawala, Hundi, and Feiqian. However, while funds destined for money laundering are derived from criminal activities such as drug trafficking and fraud, terrorist financing can include funds from perfectly legitimate sources. Concealment of funds used from terrorism is primarily designed to hide the purpose for which these funds are used, rather than their source. Terrorist funds might be used for operating expenses, include paying for food, transportation, and rent, as well as for the actual material support of terrorist act. Terrorists, similar to criminal enterprises, value the secrecy of transactions regarding their destination and purpose. In February 2012, an amended Prerequisites FATF published a revised list of its 40 recommendations, which include a new recommendation addressing ways to prevent, suppress, and disrupt the proliferation of weapons of mass destruction, WMD. Three stages of the money laundering cycle. Money laundering often involves a complex series of transactions that are difficult to separate. However, it is common to think of money laundering as occurring in three stages. Stage 1, placement, the physical disposal of cash or other assets derived from criminal activities. During this phase, the money launderer introduces the illicit proceeds into the financial system. Often, this is accomplished by placing the fund into circulation through formal financial institutions, casino, and other legitimate businesses, both domestic and international. Examples of placement transactions include the following: blending of funds, commingling illegitimate funds with legitimate funds, such as placing the cash from illegal narcotics sales into a cash-intensive locally owned restaurant. Second point, purchasing significant stored value card with currency. Next point, foreign exchange. Purchasing foreign exchange with illegal fund. Next point, breaking up amount, dividend cash into small amount and depositing it into numerous bank accounts in attempt to evade reporting requirement. And also currency smuggling, cross-border physical movement of cash or monetary instruments. And also loans, repayment of legitimate loan using laundered money. Stage 2, layering, the separation of illicit proceeds from their sources by layers of financial transactions intended to conceal the origin of the proceeds. The second stage involves converting the proceeds of the crime into another form and creating complex layers of financial transactions to obscure the source and ownership of funds. Example of layering transactions include electronically moving funds from one country to another and dividing them into advanced financial options and or markets. Moving funds from one financial institution to another or within account at the same institutions. Converting the cash placed into monetary instruments. Reselling high-value goods and prepaid assets stored value products. Investing in real estate and other legitimate businesses. Placing money in stocks, bonds, or life insurance products. Using shell companies to obscure the ultimate beneficial owner and asset. Stage 3, integrations, which supplying apparent legitimacy to illicit wealth through the re-entering of the fund into the economy in what appear to be normal business or personal transactions. The third stage entails using laundered proceeds in seemingly normal transactions to create the perceptions of legitimacy. The launderer, for example, might choose to invest the fund in the real estate, financial ventures, or luxury assets. By the integration stage, it is exceedingly difficult to distinguish between legal and illegal fund. This stage gives a launderer the opportunity to increase his wealth with the proceeds of crime. Integrations is generally difficult to identify unless there are great disparities between a person's or company's legitimate employment, business or investment ventures, and a person's wealth or company's income or asset. Example of integration such transactions include purchasing luxury assets such as a property, artwork, jewelry, and high-end automobiles, entering into financial arrangement and other ventures in which investment can be made in business enterprise.